What's up, everybody? This is Ricardo Rodriguez.
And Matthew Messick.
And this is
the Profits Over Wages podcast.
Welcome to another episode of the Profits Over Wages podcast, where we do weekly interviews with highly successful business owners and entrepreneurs. We discuss life, business, and entrepreneurship to bring forward the lessons learned from success and failure, and most importantly, have fun while doing it. On episode 34 of the podcast, we talked to Jefferson Lilly. He's a mobile home park investment expert, educator, and industry consultant who has been featured in the New York Times, Bloomberg Magazine, and on the Real Money TV show. Prior to co-founding Park Street Partners in 2013, Jefferson spent 7 years investing his own capital at Lilly Company, where he acquired and continues to operate mobile home parks in the Midwest. Prior to becoming an investor full-time, Jefferson spent 10 years in sales leadership roles with several venture-backed startup companies in Silicon Valley. He is also the host of his very own podcast, Mobile Home Park Investors, the first podcast to be dedicated to investing in the mobile home parks. On this episode, we talk about why the mobile home park industry is a compelling business. We really go in depth about investing in mobile home parks, the pros, the cons, what to do, what not to do, the due diligence process, and financing. Jefferson also gives us an insight on how he went from 1 to 2 to now 25 mobile home parks and the growing pains that came along with the journey, and how he overcame them. Enjoy the show.
Thanks for being on the podcast. I want to, we really appreciate you taking the time out of your schedule to be here.
Yeah, thanks for having me, Matthew.
Yeah. So, for our listeners who aren't familiar with you, can you tell us, who you are and what you do?
Sure. So my name is Jefferson Lilly. I own up to about 25 mobile home parks. Some of that myself, most of it in a partnership, Park Street Partners. But we've got now around 2,300 pads. That's what we call them in the mobile home park world, about 2,300 pads in 25 different mobile home parks nationwide. We improve the parks. We run them right. We create affordable and we think fairly safe housing for families that typically make, say, $35,000 a year and less. So we're expanding the supply of affordable housing and helping folks actually become homeowners that really otherwise wouldn't have a path to owning a traditional site-built house.
In how many different states is that in that you own those mobile home parks?
We are in, I believe, 12 states now, coast to coast. We're in Washington State. We're in North Carolina, Florida. Those are our coastal markets, but most of what we do is in the greater Midwest. Kansas is probably both sort of our geographic and economic center of our business, where we've invested the most amount of money. But we also own, in Wyoming and Minnesota and Wisconsin and Ohio and Michigan and Oklahoma and Illinois and Indiana. I think that's mostly all. We just also did buy in New York State. So I think that's 12, but this is mostly a Midwestern business, but again, where we've been able to buy properties at Midwestern prices on the coast, we're happy to also buy in states with oceanfront. None of our properties are actually on the ocean, but you know what I mean.
Yeah. Now, before we get into like a lot of the details about mobile home parks and all the pros and cons and all those things, how did you end up getting into it? Because I was reading a little bit on your bio, and you invested initially and then kind of went deep into it after a while. But how did you get into it? Like, why mobile home parks?
Well, Ricardo, as I say, when I woke up from the concussion, it just seemed like a good idea to buy a mobile home park. It is an unusual business. So I was working a day job. I was working in high tech out here in Silicon Valley, and was working a day job. And I just started thinking, that basically I should diversify out of the stock market and get into value-based real estate. I've been a long-term Berkshire Hathaway shareholder. I'm a big fan of Warren Buffett. Not in his league as an investor, but I try and emulate his value investing to the best of my limited abilities. Mm-hmm. So I wanted to buy real estate. And then honestly, I thought, well, why don't I buy an apartment building I figure I don't mind going to work. Maybe I put on a new roof, put in some new kitchens, make it better for the tenants. I'm not the guy to swing the hammer, but I would, general contract out that work, make an apartment building better for tenants, and then bump the rents, make it better for me. Everybody wins. So in researching then multifamily, of course, there were, 99% of everything that's out there are apartments.
Yeah.
But periodically my searches would turn up a mobile home park that was, say at a 10 or 12 cap, which for any of your listeners that don't know, that basically means an unlevered return. If you buy, say, for $1 million at a 10 cap, you're going to make $100,000 a year. It's a 10% return. So most of the apartment buildings, were more like at an 8 cap. You'd invest the same $1 million and you'd quote unquote only get $80,000 a year. Anyway, so I saw, mobile home park yielding more money, and I thought, well, that's absurd. I'm not buying a friggin' trailer park, and I delete the search and do the search again. And kind of wherever I was bouncing around, I was typically looking in the Midwest. I knew I wasn't going to find anything really that was value real estate in the San Francisco Bay Area. But again, just looking in Peoria, Illinois, Lubbock, Texas, Omaha, Nebraska, I kept seeing these like 1 in 100 properties that were yielding so much more. And so after getting hit over the head, I don't know, 5 or 10 times and deleting searches, I finally thought, well, mobile home parks are multifamily. And if they really yield that much more money, why don't I look into it? So I did that. So I started, basically reading every book that I could find, listening, books and tapes, and going to a seminar. I put together an unofficial advisory board of kind of, just by networking, I found about 10 guys that owned mobile home parks. And anyway, so it basically clicked after doing some research, and we can get into that, of course, here on the show, but it clicked as to why mobile home parks are such a better investment than single family homes or apartment buildings or really, self-storage facilities or Kentucky horse farms or shopping centers or any other niche. Mobile home parks really are special and unique. They're just hard to find, and it's a very, very small niche, but it is a very good and profitable niche to be in.
So it was all data driven essentially.
Basically, yeah. I looked at a lot of numbers. So yeah, there was a lot of data indeed, but also just, a lot of personal anecdotal stories. Again, as I said, there were about 10 guys that I had managed to network around and find that would, that were all very generous with their time. And they told me about their experience owning mobile home parks. And then as I really dug in and started reviewing deals, I would show these deals to, most of those 10 guys. And, some of the deals they'd say, hey, thumbs up, that's awesome. Other deals they'd say, no way, here's why. Some of the deals they'd say, hey, Jefferson, I just don't know, but the key issue is, X. You go figure out X. And then you're going to know if you want to buy this deal. So it was enormously helpful just to be able to have about 10 guys that had been in the business, had firsthand experience, and that were willing to share with me.
What did you do in Silicon Valley? Like, if you don't mind talking about your experience there.
Yeah, sure. So I spent about roughly the decade prior to getting into mobile home parks. I worked in Silicon Valley for 3 different startups, all 3 of which have now been bought. One of them, okay to well. The others really weren't that great of a transaction. This is what you don't hear about Silicon Valley. You only hear about the people, like Mark Zuckerberg that start Facebook and make billions. And, the vast majority of Silicon Valley startups really never transact. So I guess I was lucky to be part of 3 that actually did sell. But only one of those 3 really sold well enough that we, the employees, made some money. For the others, it was just kind of the capital, the venture investors that made some money. Actually, the last deal, almost all the venture capitalists even lost money. And it was only the firm that came in at the very last round after a couple $100 million were invested. Only that very last small round made some money. So you won't read about that. Nobody's ever heard of that company. But unfortunately, that's more the reality for 99% of the 90 something percent of the time in Silicon Valley is you don't have anything that really resembles a home run. But yeah, so honestly, initially I was just looking for some passive income. That's kind of why I got into real estate, to supplement my W-2 income from these startups. And again, none of them had really turned out to be Google. I was not a billionaire from having worked in Silicon Valley. So I was looking again for some additional passive income. And after about a year of owning a park, and I still had my day job, so I had my feet in both worlds, the W-2 world and the passive income world. After about a year, again, that last startup wasn't doing real well. And I could see that my mobile home park was doing reasonably well, and I was putting virtually no time or money into it. So I switched. I figured I'd switch really for just about a year and I figured I could double my floor of income by putting some time and money into my park. And then I figured I'll go back into high tech and I'll take another swing at trying to find the next Google and becoming a billionaire. So here we are 11 years later, and I've obviously not gone back into high tech. I'm not a billionaire, but I certainly make a lot more money than my friends that haven't struck it rich with the big IPOs. So I guess I've sort of taken off both the extreme upper end of what my financial future might be, but also the extreme lower end. And it's nice just to have, stable and good income coming in. Again, I've got friends of mine that are in their 50s working in high tech that still haven't made any real money. And I won't be that guy, but I also won't be Mark Zuckerberg with billions. But I think I'm okay with those trade-offs. And I very much enjoy what I do.
Where was that first mobile home park? Was it
the first part?
Yeah. Or?
No, not at all. And so, this is something to kind of, for your listeners to think about, because I know a lot of real estate people think, hey, I have to buy something that's within like a 2-hour drive of my house, or maybe 30-minute drive of my house if I have to rush over there and take care of something. Most people that own real estate own, real improvements. Again, they own an apartment building and there are leaky toilets and leaky roofs, or they own a small shopping center or self-storage or what have you. The mobile home park world, at least the way we do it, is really a parking lot business. So we do own something under 10% of the houses. So 90% of all those proverbial leaky toilets and leaky roofs are on the residents. The residents own their mobile homes that are effectively parked on our land. So anyway, so long story short, in the mobile home park business, because there aren't as many emergencies and you, again, don't own most of the improvements to the land, you can buy a park that's all the way on the other side of the country. And if you do your diligence right, and if you have a good on-site manager, you can do that. It's not hard to manage a good mobile home park from a distance because it's only the land to take care of. You're talking about mowing lawns and some snow shoveling and some plumbing.
You can sub that out. Yeah.
You can sub that out, which is what we do. Yeah, I don't do any of my snow shoveling or lawn mowing or plumbing work. Anyway, so to answer your real original question, the first park I bought was on the way south side of Oklahoma City, kind of out near Norman, where OU is, Oklahoma University. So we're in a little town called Slaughterville, which is to the south of Norman. So basically, we're kind of a suburb of a very healthy college town.
Gotcha.
It is still Oklahoma. It's not like Berkeley or Boulder, for those big college towns. But there's still, 30,000 students at Norman, which is 8 miles up the road. So I bought in a town nobody's ever heard of, but it's very close to a very healthy suburb of Oklahoma City, which itself is a fairly healthy, larger economy. So those are some of the key things to look for.
How did you find it? Was it just
eBay?
On eBay, really?
Really? No,
I bought my first park off eBay. I didn't literally click and PayPal the guy $500,000, but it was basically a classified ad. I picked up the phone, I called, I did some diligence, I got it initially under really sort of a letter of intent, and we negotiated a bit on price. So after doing some diligence from afar and getting it under at least this LOI agreement, I do things differently now. I get things under a definitive purchase and sale agreement. But anyway, after getting some paper signed on it and doing diligence on the phone, I then hopped on a plane, flew out there, met the guy, did diligence in person, met a couple of the tenants, met the manager, drove through competing parts, talked to the police department. I did all the usual sort of on-site diligence. And then we moved forward with closing on the property.
So, couple questions on that. Did you fund that cash, or did you raise money from a third party?
Oh, well, so kind of neither. So a third party meaning a bank. Yeah, so I don't have an equity partner there. So that was just some of my own personal savings, a little under $100,000. I borrowed 300 some odd from a local bank. And for small deals like that, basically any deal under, say, $1 million in debt, which would mean your purchase price might be $1.25 million to $1.5 million. Most any deals at that size, and below, are only going to be financed by a local bank. If you're able to buy a larger property, $1.5 million, certainly $2 million and up, then you've got additional opportunities. We, for instance, do a lot of CMBS financing, which is debt that gets chopped up and sold off on Wall Street. Mm-hmm. So for larger deals, you can do sort of fancier and cheaper money that has no personal recourse. But really for sort of, 6-figure deals, you're looking at bank debt or seller financing if you can get a seller to take back a note. But anyway, I got bank debt, that's personal recourse, a little bit higher interest, but I still make good money on that deal and always have.
How many pads was that first deal?
That first deal was just 66, and it was about a third empty at the time. And so I both bumped the rent, and then I also paid cash money for mobile homes and brought in about 24 mobile homes, which I've been selling to the tenants. So again, shifting the burden of all the maintenance to a tenant, but also encouraging better behavior out of tenants, right? When you give someone a shot at owning something, and there's nothing like 30-year mortgages in my world. My tenants will own their homes on average in about 5 years. They'll become homeowners that quickly. So you let somebody see the light at the end of the tunnel towards becoming a homeowner. And lo and behold, someone that maybe was kind of a mediocre tenant in an apartment building, now that they've got a shot at home ownership, lo and behold, they're treating that house better. The maintenance costs really aren't that high, but they do take care of most of the maintenance, certainly the minor stuff, broken windows and leaky toilets and that kind of stuff. But anyway, so that's what I've been doing. So a lot of those homes now have sold to tenants. I still have some paper, but I'm very hopeful over another couple of years that most of those tenants will again become homeowners, and then I'm back to just owning the land. I think of it like a parking lot, and my management and time involvement will be even less once that property is full as a parking lot. Right. But we still got another couple of years before we get there.
No, just another question on that, because just from somebody's perspective, right? If they want to get into mobile homes, on that first deal, you said you did all this due diligence, but how did you know what to do? Did you take a course? Was that all the research that you had done, or how did you know what to do essentially?
Yeah. So again, it was a lot of books. It was again also going to my advisory group. So the key things that you're looking for, and I did bend or even break some of these rules. So you got to decide what risk and reward you're comfortable with. But kind of the ideal park, if such a thing exists, is to buy, say, within 5 miles of a super Walmart. That would indicate that the economy is pretty healthy. You don't have to have, Bay Area, Silicon Valley, type of growth. You just really need to have a town that is flat and not declining. So again, say you're within 5 miles of a super Walmart. Walmart generally only puts super Walmarts in towns that are at least economically flat, if not growing. So you want to be, so that kind of gets you fairly certain that the economy is healthy. We still run test ads, usually on Craigslist. You're going to want to see 20 or better responses per week. From Craigslist, that'll further validate that it's a good economy. You then want to buy a park that's got good infrastructure, and certainly for first-time buyers, I would recommend only buying a park that's on city water and city sewer. Whether the roads are paved or not doesn't matter anywhere near as much as just being on city water, city sewer. Mm-hmm. And then you again, ideally want to buy a park where the tenants own all or nearly all of their homes. If you buy a park that's been run like a horizontal apartment building, where, for instance, the previous owner owned all or nearly all of the mobile homes and was renting them out, then you've got a real culture change to manage with that park, and you'll lose a lot of your tenants as you begin to say, hey, we want you to buy these things. And frankly, folks with renters mentality turn over about every 2 years. So most all those tenants will be gone, 24 months after you buy it. So you've got to be prepared to pick some homes and then only put them out on rent to own agreements. But anyway, so an ideal thing, again, really looking for the economic health of the region and the physical infrastructure of the park. And then again, ideally that the previous manager has built a culture, built a property of owners rather than renters. And finally, you generally want to make sure that the average house price, site-built house price, is $100,000 or better. Again, that further validates that it's a healthy economy. For instance, you won't find a lot of this in places like Detroit and Toledo, where the average house price might be $60,000. That can be the kiss of death. You can't find good tenants in places like that. But there aren't too many places like that. So anyway, that's kind of in a nutshell, the sort of diligence that I did.
Gotcha. So when you're looking to buy a mobile home park, is it better to have something where, because you said that one was a third of it was unoccupied. Would you rather buy something where it's like, 90, 95% occupied? Or do you want something where maybe it was mismanaged, because then you could buy it for a lower price and then you can improve it for value add yourself?
Yeah. In general, we'd rather own a park that's more full. It does take some combination of money and or time to get it infilled with homes. So, the perfect park is one, say, that's 100% full, but lot rents are half of what they should be. It's, of course, really easy to just put out a rent increase notice and take rents to market. Those deals are extremely hard to find. So most of what's out there are deals where lot rents are more, fair at market. But yeah, like my first park, you've got, 20, 30% vacancy. And then, there are some finance companies that will finance mobile homes, or you have to come out of pocket and just pay cash, $10,000, $20,000 a piece to buy used mobile homes and bring them in yourself. Of course, or you could spend $40,000 on a brand new home. So what's really key, what's really critical, what really drives value is in-place cash flows. People that already own their mobile home, it's parked on your land, and they're paying you rent. It's not impossible, but it's definitely a lot more work to be finding mobile homes, coordinating, getting them moved in, hooked up to the utilities, especially if they're used. Now you got to find a crew to rehab the house, make it ready to go out on a rent-to-own agreement. All that clearly adds value, but I think a lot of first-time buyers tend to underestimate how much work it is to be bringing in homes. So the perfect park is already 100% full with really great responsible tenants in newer homes, but the lot rents are half of what fair market is. Again, those deals are extremely difficult to find, but that's the perfect deal.
So let's go ahead, Matt.
Well, how do you find a lot of your deals?
Mostly from
eBay.
Yeah, I haven't bought anything else off eBay. I bought one off Craigslist. But most of our deal, that's 2 out of 25. Most of our other deals have come from brokers. So you need to outreach to brokers. I haven't had as much time. I've just gotten so busy with 2,000 some odd pads. I don't have as much time as I used to. But, frankly, just driving the speed bumps, as it were, if you really want to own in a certain town, drive into those parks. See if the owner might even live in the park or be working there. That's a great way to find deals. I no longer have time to do it, but that's a great way to find deals, is just go to a town and, drive around, see what you can scare up. So, or send, postcards or make phone calls, that kind of primary sourcing is another great way to find deals in addition to brokers.
So just to kind of piggyback on what we were talking about, people wanting to get into mobile home parks, what are some of the mistakes that they could avoid when first getting into it?
Yeah. So again, buying, say, a property on a well and or with septic or a sewage lagoon, very often parks that have that kind of poor infrastructure that are for sale because the infrastructure is failing. Now, an unscrupulous seller won't tell you that.
Right.
But that would be a big mistake, to just listen to a seller that says, oh yeah, the septic is working great, the sewage lagoon is just fine. When those go bad, that can be, septic might be, say, it depends where you are in the country, but replacing septic might easily be $3,000 per pad. Mm-hmm. So, you buy a 100-space mobile home park. Now, all of a sudden, you've got a $300,000 expense to make that right. And a sewage lagoon could say, it'll vary where you are in the country, but a failed sewage lagoon could be twice. So that could be a $600,000 expense, or a packaging plant. If you're made of money and you're willing to take that risk, again, there are no black and whites, but there's a lot of gray. But for a first-time buyer, especially if you're thinking like, hey, I'm only going to be able to put down, say, $250,000 on $1 million park, you don't want to be 6 months into the deal and have to come up with another $250,000 to be fixing the infrastructure. Anyway, so that's a mistake that I see first-time buyers make. They buy parks that have bad infrastructure, even though the seller says, "Oh, it's fine. I've never had any problem."
Well, they're going to tell you anything to sell it, so it's like
they're going to tell you anything to sell it. Yeah. Now there are people, not regular plumbers, but there are other sort of specialty plumbers that do nothing but inspect and repair septic fields or sewage lagoons. And things like packaging plants and sewage lagoons can even get into the realm of full-blown engineering and hiring, civil engineers to make sure all your flows work correctly. I've been through this, trust me. So just, your engineering fees might easily be $50,000 on some of this stuff before you actually hire anybody to dig dirt and replace pipe. Just engineering, white-collar work can be, well into 5 figures before you then get into 6 figures of blue collar, digging and replacing your actual infrastructure. Anyway, so that's a mistake that first time buyers make. Then, as I said, why it's important to not buy a horizontal apartment building, as we call it, or at least go in with your eyes wide open. If you buy a property where the tenants are all renters and the previous owner owns all the mobile homes, again, you're going to experience, no matter what you do, you're going to experience extraordinarily high turnover, because that's the way renters live. They blow in and out of a town in 1 or 2 years, or they move, Anyway, so you're going to have virtually 100% turnover of your tenants over the next 2 years.
Right.
What that means is a lot of them, let's say you've got 100 mobile homes, could easily be, again, $3,000 to $5,000 per mobile home to repair it and put it back out on a rent-to-own agreement. So again, there could be another, $300,000 in repairs, $500,000 as you might have to fix up homes. So you don't want to get into a cash flow downward spiral where, again, a home comes available, you're coming out of pocket to repair it, or heaven forbid, you don't have the money, and then another home comes available, again, abandoned and it's damaged. And now, again, you've got worse cash flow. So it's critical, especially for first-time buyers, to buy a park on good infrastructure and where the tenants own virtually all of the homes. 10% is fine, 20 maybe, but again, buying a horizontal apartment building can really be a downward spiral for folks when those renters turn over. Once you manage the park into the future and it has all owners, then you're in a much better position, but you've got to have the cash flow to bridge to that brighter future where everybody owns their home and everybody is nearly everybody is a responsible tenant, and taking care of their own home.
Yeah. So go ahead, man.
You go ahead.
No. So I mean, you said you have 25 parks, right? How do you manage, having so many parks all over the country? Like, do you?
Yeah. So this is what I call mobile home park 2.0. And I've done my own podcast on this, and I've bumped my head plenty of times as we've grown. So it's real easy to buy, one park, 50, 100 spaces, even a couple of parks, you get up a couple hundred spaces. It's easy to do that, do all the accounting, do all the maintenance, put all the ads up on Craigslist. It's easy to do that entirely yourself. When you get to 500 and certainly 1,000 pads, now you've got a real business. This is no longer just sort of, passive income, or I'll spend a little bit of time Saturday afternoon putting up my own ads for my park that's a couple hours away. When you get to 500 to 1,000 pads, depending again on how many you own versus might be rentals, but somewhere in that range, you now need to start hiring employees. You need job descriptions. You need bonus and compensation plans. You need healthcare. This is no longer a passive business. This is a real operating business. So we've got, for instance, all the parks have their own on-site manager. But all those managers in turn now report into our asset manager. That's a real, 6-figure salaried person, that's a serious head. And then we've also got accounting staff that are doing, we've got one person who does nothing but pay bills. We've got somebody else who does nothing but, check all the receivables, make sure that all the tenants have paid. Of course, the managers are also responsible for making sure everybody pays. But again, we've got somebody at headquarters that does that. Plus, we've got a controller now. Plus, we've got a guy who's basically an analyst, associate. He floats around and helps out in a number of different ways. So we've now got effectively 5 people at headquarters. Plus, we've still got my partner and me, so that's 7 people. Plus, we've now got somebody on site, 25 other managers part-time. This is not a full-time job to manage most mobile home parks, but we've got on-site managers, another 25 of those. So that's like 30 some odd people now, most part-time, some full-time. But yeah, when you get over about 500 pads, you got to be prepared to be a boss and, again, write job descriptions and hire people and really have an operating business. If that's not for you, then maybe you just buy a park or 2 and you get to 100 pads, and maybe that's as far as you go. There's nothing wrong with doing it all yourself. But if you want to scale, you got to get headquartered. We've got rent now. We've got an actual headquarters building, part of a building. We've got actual office space, and anyway, that's how we manage now 2,300 pads.
Well, yeah, let's get into some of the numbers. So what is an average, how many pads does the average park have, or an average size park?
Yeah, probably the average, we've moved towards buying a little larger than average. Ours would be about 100 pads, but I think nationwide, kind of an average park, probably half that. It's probably 50 pads. You can find parks, theoretically, any single piece of land with 2 or more mobile homes on it is a mobile home park. But there are smaller pads out there that are, smaller parks out there that are, 5 pads, 20 pads. And then again, some of the largest would have over 1,000. And those definitely now tend to be owned by some of the big REITs. some of the institutional investors. So we're kind of in between. We don't do a lot of 10 and 20 space parks. 100 would be our average. But again, some of your listeners that might not have as much money, that might want to get started, with $20,000 down on a $100,000 park, that's doable. That might be the price of a 5 or 10 space park. And especially if you can get a seller to carry back paper, you could get into this business for that little. But anyway, 50 is probably about the average. Nobody knows for certain. It's very hard to find real data on this business.
What's like an average monthly rent for a pad?
Say nationwide, $300 might be average. $250 to $300 is probably average.
And as far as like operating expenses, not at corporate, but at the actual park, since you just have the pads, you're renting them, and pretty much like the entire, they own their own homes and are responsible for the maintenance. Like, what operating expenses are you responsible for as the park owner? Yeah.
So we're responsible then typically just for the land. So that's obviously property taxes. We've got a bit of insurance. It's general liability. We don't insure the dirt for, fire, flood, tornado, what have you, because even the worst, tornado or hurricane doesn't really damage the land. Right. So we don't actually insure the land, but we've got general liability insurance. We've got, of course, our on-site manager. We've got a phone system at, anywhere between 30 and 50 a month, depending on call volume. And then really we've got plumbing is probably some combination of management and plumbing would be kind of our biggest expenses typically. We're again responsible for everything in the land itself, and the pipes are obviously in the land. Now again, we wouldn't maintain pipes up in the mobile home. That's on the tenant, but the water and sewer pipes down in the ground are all on us to maintain. And then again, we'd have some snow plowing for our parks, up in Wisconsin and Ohio and Michigan, and then a little bit of lawn mowing. Although as a park gets full, your lawn mowing expenses decline because you're mowing the vacant lots. Once the lots are all full, the mowing is on the tenants. So that's a nice thing when your costs, a little bit of your costs decline as you grow. We'd still mow common area, but any vacant pads we're no longer mowing as the park gets full. Anyway, so those are the kind of expenses. It works out to be about 30%. So for every dollar in rent, we pay 30 cents of it in all of those operating expenses. Yeah. Oh. Now, if we pay water might be another 10 cents. So basically, our expense load is going to be between 30 and 40%, depending on whether we pay the water or whether water is direct billed to tenants. And then, of course, we pay our mortgage, and then we keep the remaining cash flow.
Yeah, that's what I was going to ask with water. What's like the standard, or is it just kind of by the state or what you decide? Like, do the residents cover it, or do you cover it?
Yeah, so this is a way to add value. Probably most parks are what's called master metered. So that means there's just a big old meter at the property line, and the water company just sends a big old bill, $4,000, $6,000, $10,000, who knows? But they just send that to the owner, and a lot of owners have not submetered. It is perfectly legal to put a meter on a tenant's house and start billing them at cost. You generally don't want to make a profit on the water, but it's perfectly legal to just put a meter on their house and bill them at your actual cost of the water. And lo and behold, well, two things will happen. First, your tenants will conserve, typically by about a third. So what might have been, round numbers, say a $10,000 a month water bill will now become more like a $6,500 a month water bill, because you're encouraging tenants to conserve because they're reimbursing you for their water usage. But what you'll also find is that there might be another 10, 20% of leaks. Even once all of your tenants are paying fully for the water, you'll find like, hey, I'm still, I'm billing the tenants. They pay $5,500 a month to reimburse me for water, and my bill is still $6,500 a month. Well, that extra $1,000 a month is leaks on your side of the meters, the park owner's side. And owners don't know that until they actually submeter for water and realize, again, that the amount of water getting into the mobile homes is less than the amount of water that comes into the park at the property line. That's leakage. So I've had one of my parks where I cut the water bill by half. And it was, again, a combination of submetering and encouraging conservation. It's always nice when what's right for the environment is also what's right for your pocketbook. But then I also discovered leaks. So anyway, long story short, I cut my water bill in half. And again, that remaining water bill gets billed through to the tenants. So I effectively completely removed a water bill, if you will, off my P&L. Anyway, so water is a great way to add value, economic value to a park, and again, also do what's right for the environment.
And then with the park managers, so they're part-time, do you pay them something? Do you give them like free lot rent or a combination of both?
Yes. So this will vary a bit in the country, but let's just say typically our managers would get free lot rent. So if our lot rent across our portfolio might be on average $300, so they don't pay $300, and then we would also pay them about $10 per occupied pad. So if they're managing a full 100-space park, then that's 100 times 10 is 1,000. So they'd get $1,000 a month plus not pay their $300 in lot rent. They get $300 rent. They get $300. That's effectively really a tax-free benefit to them, not the $1,000, but that $300 in free rent. So that would be typical. Again, some variance, whether you're closer to the coast or where you are, how nice the community might be. But that's about the size of it. Our managers are part-time. They're independent contractors. They set their own hours. They figure out how to collect the rent and deposit it on their own. And most of them, again, because it's such a part-time work, might be on a park like that 5 hours a week, maybe 10. But most of our managers have some other part-time or even full-time employment where they're an actual W-2 employee and getting benefits and that stuff. So we're a little extra fringe benefit on top of really what their main source of income is.
And then also, how does it work with if someone stops paying, with evictions? Because technically they own the house. It's not actually like a house. Is it characterized as an automobile? And then
it is. Yeah. Good question, Matthew. Yeah. So mobile homes, as we say, are not real estate. They're wheel estate. They actually have a VIN number stamped in them, and title in almost all states, title trades through the DMV, just the same way it would for a car or a jet ski or a camper. Anyway, yeah. So this is personal property. Frankly, if somebody owns their own house, it's very rare that we ever have to evict anyone. They're not going to lose a house over $300. They'll beg, borrow, and steal to come up with that money and pay us. In general, the people that we have to evict are folks that are trying to do a rent-to-own agreement with us, or they're outright renters that came with the property because the previous owner allowed renters. Those folks, renting a home might be paying $600, maybe $900. That's a bigger nut to come up with. And again, folks that are renters just aren't as reliable as people that are owners. Right. So it's very rare that we ever have to evict anybody that's an actual home owner. But it has happened. Honestly, it was like 3 or 4 years before it happened to me. I was in this business like 3 or 4 years before I ever actually had to evict anybody who owned a home. It was a much older home, probably only worth a couple $1,000, and they just signed over title to me. They probably owed with a couple months back rent and legal fees. They probably owed almost $1,000 anyway. So So that's typically what happens is that folks will just sign over title, and they'll just move on. And then we, again, sell the house to someone else and give them a shot at homeownership.
What are some of the, kind of to switch a little bit here, what are some of the growing pains that you encountered when you went from 1 to 3 to 5 to 10,
the growing pains mostly have been around going from what I call mobile home park 1.0, which is where I was doing everything myself, answering phones, doing my own QuickBooks accounting, general contracting, finding plumbers myself, finding guys to carpet a house myself, on and on. And frankly, even my partner and I did that ourselves for the first 8 or 10 parks that we bought. So the growing pains have been getting to mobile home park 2.0, where we now have actual employees. This thing is a real operating business. And, again, we have somebody that just does nothing but pay bills. That was what my partner used to spend too much time doing. But yeah, so it's all the growing pains mostly have been around people, finding the right people, figuring out, how many people we need and how we're going to grow and what their job descriptions are. And we're still not perfect, but we're getting better. But if you choose to grow that much, once you get the right people on board, then again, the growth becomes easy again, because you've now got a platform to just sort of bolt on a new deal. And the payables person knows how to pay the bills. And the person that advertises up on Craigslist knows how to do that. And, it's just one more thing, because you've already got the right people in place, again, rather than trying to figure out how to do all that.
So mostly
that's where it pays me.
So mostly management. What about when it comes to financing? Does it get a little bit easier once you get more, or?
Yeah. It's generally easy no matter what the size or scale. But yeah, it probably helps us a bit, especially on some of the CMBS stuff, kind of the fancy Wall Street debt. Because we're now more of a proven entity. We've already done, we've probably done 7 CMBS deals out of the 23, something like that. So yeah, that makes it a little easier. And then we know more what to expect. Getting that kind of debt is just a phenomenal amount of, reporting and taxes and all kinds of stuff. So I think we're better at having all that paperwork prepared. There are a lot of legal opinions. It's probably every bit of $50,000 of legal just to get CMBS debt in place. It's incredibly expensive right up front. The interest rates are lower than borrowing from a bank. So again, if you're doing kind of a bigger deal, you're borrowing long term, you more than make up. But yeah, it can be like $50,000 in legal right up front just to get that debt in place. Anyway, but yeah, it gets a little bit easier, but by far it's finding the right people and really, doing a good job of managing them that is a pain point. That is where the rate limiting step is. It's the soft, squishy stuff of people. It's not financing. It's not deal flow. It's people, motivating people, building right job descriptions, all that stuff that's, again, like I say, it's kind of squishy. It's not black and white. You can't just figure it out in a spreadsheet. You kind of need to feel it inside you and figure out what sort of organization you're going to build. That's really what, where we've bumped our heads. I think we're doing a lot better now than we were a year ago. But yeah, that's when you get over 500 pads, that's kind of what will hold you back, is building an actual organization of highly functioning, great people.
What other benefits are there to mobile home parks before you switch a little bit here? Depreciation, tax benefits,
Yeah, that's a great question. So, I had talked to some investors. Even today, I still hear from investors. They say things like, oh, yeah, that sounds great to, only own the land and have high margins, high cash flow. But they say things like, but Jefferson, everybody knows mobile home parks are unimproved land. So you've got no depreciation. Right. So you're naked. Your earnings are naked to taxes. And I say, no. believe it or not, our depreciation is almost twice what it is for buying apartment buildings.
Right.
And that really shocks a lot of investors. So if it were only unimproved land, it would be, a cornfield or something, or scrub oak, and there would be no roads, no water, no sewer pipes, no wells if you have that, no septic if you have that, no clubhouse, no fencing, no signage. Most all mobile home parks have some combination of that. Again, hopefully not the septic and the well. But anyway, there are actual improvements to the land. And then, and most of those improvements come down over less than 27 and a half years. If you buy an apartment building, typically you're taking down the bricks and mortar, the improvements, over 27 and a half years.
Right.
So if I can get this right, I think it's that roads are 27 and a half years, but pipes are 20, and things like signage and fencing are, I believe, 7. On average, we're able to depreciate our parks more like over about 17 years. So that's not quite half the 27 and a half years that's normal for most real estate. Furthermore, if we overpay above and beyond the improvement value, that's called goodwill. And goodwill is 15-year property. So between, again, physical assets coming down over about 17 years, any extra for goodwill coming down over 15 years, again, on average, we're able to depreciate still 75, maybe even 80% of a purchase price over about half the time as most apartment building investment. So yeah, so we get almost twice the amount of depreciation and amortization as if we were buying apartment buildings. So we have a much greater tax shield than most any other niche in real estate.
Interesting. Because that was like why I was thinking about it. I'm like, yeah.
Like there's nothing to depreciate there.
Right.
There's plenty to depreciate. Yeah. So we look, the non-depreciable part is the land. And so at the time we buy a park, we will look for comps, comparable sales of truly raw land in and around that town. And then we know, hey, raw land, say, goes for $20,000 an acre here. We paid $80,000 an acre. So in that case, we know we've got 75% of the purchase price. That's $60,000 per acre of land. We know is either, again, going to be assigned out to the pavement, the pipes, the fencing, what have you, or it's goodwill. Anyway, so that's how we figure out roughly what the non-depreciable true raw land cost is, which is typically, say, 25%. So again, it's usually about 75% of our purchase price we get to take down one way or the other over 15 to 17 years.
So another question, just kind of before we go into like your podcast and all the other things that you're doing here. What's the conversion ratio when it comes to like rent to own? Do you have like 100% turnover from when they come in and to when they buy their own mobile home?
Yeah, so that varies. Yeah, so one of the parks that I bought myself, this is not in our Park Street Partners partnership, but one of the parks that I bought myself was a horizontal apartment building. The previous owners rented all but one of the units. It's a smaller park, about 20 spaces. Mm-hmm. So I got 19 renters out of 20. Yeah, and so almost all those renters turned over. I think we do have either 3 or maybe 4 folks now that are the old original renters that now own their homes. But most of the others just turned over. So what varies is how well the previous owner checked backgrounds. That previous owner was very lazy, did not check anybody's background. That previous owner would just meet people in person and just get a feel about them. And if he liked them, they'd just pay him the first month rent. And I actually just did a podcast on this exact subject. So what he was doing without consciously thinking about it, what he was doing was filtering for the worst possible residents, people that had something in their background that they did not want checked. Obviously, could be a felony or some crazy bad credit. He would just meet them in person. And of course, he's also opened himself up for like discrimination lawsuits. If someone in any protected class said like, hey, you let that other guy in, but not me. It's because of my skin color or because of my sexual orientation or just because of whatever. Like by not outsourcing to a third party that really checks backgrounds in an unbiased way, which is the way we do it, he was opening himself up to a potential lawsuit. It didn't happen. But again, anyway, so he opened himself up to that liability. And then again, he took no down payment. So he's filtering for people that have a bad background. He's taking no security deposit from them, so they have no motivation to leave the trailer in any clean condition because they can just blow out of there. So so I had sort of like 16 out of 20 people turn over actually in about a year or a year and a half. Now, I had the capital. That wasn't a surprise to me because it was not my first park and I knew what I was getting into. And I had the capital to invest in the homes, to renovate them, and get them sold on rent-to-own agreements. But anyway, so if you buy a park where nobody has done diligence on the tenants and there are no security deposits, you're going to have very high turnover. If you're buying a park from an owner that did great background checks and had high standards, and all the renters actually have a security deposit, you're going to have much lower turnover. When people do turn over, they're going to leave their homes in much better quality because they're going to want their security deposit back. So anyway, that's a long-winded way of saying it's going to vary what your turnover will be and how many of your tenants will want to become owners. But again, if they're good quality tenants that have put down security deposits, you can say, hey, I'm going to take your security deposit as a down payment on your house, and you just keep paying me rent for, say, another 36 months, 3 years, and then I'll sign over title to you. And if they're good quality renters, many of them will go for it, meaning something more than half. If they're bad quality folks, as was the case in my park, but I knew that going into it, but if they're bad quality tenants, then you could have, closer to 100% turnover.
Now let's talk about your podcast. Because I think you're like at 120 something episodes now. Is there that much to talk about mobile home parks?
you would think, like, how could there possibly be that much to talk about? But I mean, I could podcast every day and do a podcast every single day if I had time. There's always some crazy news story or some other owner that, I can interview and talk about how they got into the business. There's more going on in Washington, D.C., some regulations, some interesting new things coming out of HUD. There's an enormous amount. So my partner and I started the world's first podcast just dedicated to mobile home park investing. It's simply called Mobile Home Park Investors. And you can just find it on Stitcher or iTunes or Google Play, or our website is mobilehomeparkinvestors.com, and that'll link them through to it. My partner and I talk about, our own war stories and how we have found deals and gotten them financed, what sort of on-site diligence we've done, what sort of off-site diligence we've done, on and on. And we've interviewed Jim Clayton. Jim's I think he's a billionaire. He started Clayton Homes, which manufactures now almost half of the mobile homes in America. He's not a park owner. Again, he manufactures the actual mobile homes, but he sold that business to Warren Buffett 12 years ago or so. So we've had Jim Clayton on, and we've talked a little bit about Warren Buffett and what it was like doing a deal, selling his mobile home business to Warren Buffett. We've had guys on that design mobile home parks. Now, it's not easy to build these, but there are a few that get built every year. What else? We've had guys on from banks and from Fannie Mae that talk about financing. Like I said, there's so much to cover. I could do this almost daily if I had the time.
And you'd say, I think you had something how to raise like $10 million for your real estate fund, through podcasting. If you could talk a little bit about that.
So our podcast has definitely helped us raise money. Uh, so we get inquiries, I would say at least one a week, from somebody that's heard our podcast and hey, says mobile home parks are a great business, but too many moving parts, and you got to move a home here and there, and Jefferson, let me just write you a check, six figures, maybe seven figures. Anyway, so yeah, we get a fair amount of inquiries from high net worth individuals that want to invest in our funds, and we'll be launching another fund by the end of the year. Anyway, so we get that. We also get some deal flow, mostly from bird dogs, like our deal in Raleigh-Durham, North Carolina. Phenomenal market. Some guys called us with a park that's 15 minutes from Duke and 15 minutes from Chapel Hill, that was off market, and we paid them a very nice referral fee, about I think $75,000 for that deal. Anyway, so we do get some deal flow referrals because of our podcast, so that's great. But it is mostly that we get prospective investors that reach out and want to know more about how to invest in one of our funds.
Because it puts you in a position of the expert. You're already the expert, but it edifies you and elevates you even more on that subject.
It does. Yeah, that's exactly it. So, and it's a way to give back. Because there were a lot of people long before podcasts even existed. There were a lot of people that I learned from, some of those first 10 guys and others. So I can't ever really pay them back, but I can pay it forward. So other folks have gotten into this business. I've had people reach out to me from actually, a bunch of places, including Goldman Sachs and Apple Computer. And people have left those companies and those stock packages to get into the business. And anyway, so that's been something I would never have anticipated. Anyway, so it's a way to kind of pay it forward, but it's also a way for me to help raise money and deal flow. So, yeah.
Matt, did you want to go into the questions?
Yeah. So I'm going to ask you a few questions now, just kind of bring up some more content. But what's one thing that you wish you would have known before you got started?
How important it is, I think, to buy a park on all city utilities. My first park actually had a sewage lagoon, which did fail. And that was an enormous, $500,000 expense. I had it in writing from the government, from the DEQ, that the sewage lagoon was functioning normally. But having something in writing from government is not worth the paper it's written on. So I was naive in trusting government. Anyway, so again, I highly advise folks to stay away from parks that have, for at least your first park, just buy a park on city water, city sewer, make it easy, pay a little more, but eliminate the risk of a huge six-figure investment. So I wish I had known that and understood how important it was to buy better infrastructure. I also wish I had thought more about being a money manager. When I bought my first park, I really thought of myself exclusively as a value investor, just managing my own money in value real estate. And it took me several years to really get around to thinking about forming a partnership and raising money from outside. So I wish I had done that faster. Still would have bought a park or two on my own with my own capital to establish my track record, but I would have much more quickly than I did raise outside capital and really ramp up. So I was late to the game and changing my thinking to really being that of more of a money manager for other people's capital rather than just thinking of myself as an individual investor managing my own money.
What habits helped make you successful?
Probably perseverance. Again, it can be hard to find these. I put in several offers. I got outbid. The park that was my first park was not the first park that I put an offer in on. So you got to persevere. You've also got to be comfortable thinking outside the box. Mobile home parks are not normal, right? nobody at, your country club or your gym is talking about how they're investing in mobile home parks.
Yeah.
So you've got to be comfortable getting some really weird looks from people. When I first got into this business, I was a single man. I was at a cocktail party. One woman asked me what I did for a living. I told her I invested in mobile home parks. She let out a little smirk. She kind of laughed. She turned around and walked away from me. So you've got to be kind of, I'm sure if my wife hears this, honey, this was long before I even met you. But you've got to be comfortable thinking outside the box. You're going to have that kind of reaction from family, from friends. You've got to be comfortable making your own way, because the normal thing is to, buy a house within a half hour of your house and improve it and rent it out. That's what's normal. That'll get you no smirks. No one will walk away from you at a cocktail party if you do that. So yeah, you've got to persevere. You've got to be comfortable being different. Think different, I guess, is to paraphrase Steve Jobs' comment. You've got to think different.
What was the worst piece of advice that you ever got?
I don't know. Maybe somebody just saying, "Oh, don't buy a mobile home park. Go buy a house somewhere." I don't know what the worst piece of advice is.
Do you have a favorite failure? Is there one that set you up for future success?
Well, I'd probably just go back to the couple of things that I mentioned before, just about like the importance of buying the right infrastructure, and again, really think about whether you're just managing your own money or whether you're managing outside capital. So that'd be kind of my advice to folks as they get into if they consider getting into this business.
What's one thing that you believe to be true that most people would disagree with?
It could just be that, mobile home parks are a bad investment. Yeah, so I'd say kind of from just speaking economics, that's probably it. Or just the belief that you have to buy a property, within a half hour or a couple hours of your own house. Again, I think different. My first property was 1,500 miles away from me, and even now my closest property is still 600 miles away. So I believe I can buy remote and manage effectively remotely.
Matt? It looks like his computer froze.
Sorry. Yeah, okay. Froze for a second. What's one piece of advice that you'd give to someone just starting out in this business?
The importance of mentorship, whatever your business is going to be. If it's going to be real estate, any niche, if you're going to go off and you want to, start your own, whatever, lighting and sound design company or your own insurance agency or whatever business you want to get into, I think mentorship is enormously important. Learn from people that have actually been there, done that. Not to say that you have to do everything the way they do. Maybe you can think about it, build off how they do it, and you do it better. But book learning only seems to go so far, at least for me. So it was just enormously helpful to, again, have those initial 10 guys that were park owners that could give me hands-on real-world advice and that were, never more than a phone call away. So get mentors in whatever niche, whatever business you're going to go after.
How did you find them, or how did you reach out to them?
Yeah, so some of them I found online, but also again, just from talking to people and telling people what I was doing, what I wanted to do, that I wanted to buy a mobile home park. When I got started, of course, I didn't own one. I was just telling people I want to own one. And a lot of people just kind of looked at me, gave me quizzical looks. But, like one guy at my church just said, "Oh, mobile home parks are the best thing ever. My dad used to own one, and it was that park that sent our whole family to Europe every summer for an awesome vacation. Like, talk to my dad." So it was that kind of thing. It was kind of happenstance. It was just mentioning it to a lot of people. Just in casual conversation. So that's really how most of it came up. But again, a couple of the guys I found online. And so there's no single panacea for finding mentors, but seek and ye shall find. And again, just mention what you want, just put it out there, and I think you'll be pleasantly surprised what comes back.
Okay, last one. Why do you do what you do? What gets you through the tough times?
It's fun. It's fun being an entrepreneur. I enjoy building things. This business obviously has some real physical aspects to it, mostly where we're bringing in mobile homes. But we have also, repaved roads and done other physical infrastructure improvements. So I kind of like building, both physically that way, and then also now the more softer aspects of building an organization that, functions well and does all those things I no longer have time for. Do all the accounting, get all the ads up on Craigslist, get all the phones answered. Anyway, so this is a very entrepreneurial business. It's not as sexy as what I used to do in Silicon Valley. It's not, wireless high-tech stuff, but it's still very entrepreneurial, and I really enjoy it. And I'm building something that I'll be able to pass down to my kids. Certainly, at least the parks that I own, I anticipate handing down to the next generation. So that's kind of why I do it and how I get through the tough times. It's fun 99% of the time.
Great. I mean, that was
maybe great. 95. It's fun 95% of the time.
Great answer.
I'll be honest. 95.
Before we finish here, where could people find you and your podcast and anything to do with you online?
Sure. So feel free to connect to me on LinkedIn. Again, Jefferson Lilly, Lilly. Check out both our ParkStreetPartners.com website. We've got information there, both for folks that might want to co-own parks with us in one of our funds, as well as folks that might want to own a park directly. So ParkStreetPartners.com, and then our community, MobileHomeParkInvestors.com. Go there. That'll link you through to our podcast. It'll also link you through to our LinkedIn group, same name, Mobile Home Park Investors. We've got almost 5,000 people there in that group. It's the largest on LinkedIn, and we trade tips and tricks and deal flow there on LinkedIn. And then we also, so far we haven't been copied on this. We have been copied on our podcast and our LinkedIn group. But so far, we're still producing the industry's only calendar. So you can just click to a link and pull a calendar of events into your phone or computer. You'll see upcoming mobile home park trade shows, some of the earnings announcements that some of the big publicly traded REITs do, and other things. So again, the podcast, the LinkedIn group, and the industry calendar can all come from MobileHomeParkInvestors.com.
I'll also put them all on the show notes, for your episode, so people can go on there and click and stuff. But thank you, Jefferson. I mean, that was great. That was awesome.
Okay. Well, Ricardo and Matthew, thank you both for being here. I enjoyed being on your show. Thank you for having me.
Till next time, guys.
You.
All right. And that's it for another episode of the podcast. Hope you enjoyed it. One last thing before you head off, though. Please don't forget to subscribe, rate, and leave us your thoughts on iTunes. It would really mean a lot and help us reach more people. You can also find us on Facebook at Profits Over Wages Podcast, as well as on Instagram and YouTube. Until next time.